Good afternoon, everyone. I'm Inki Cho, Senior Financial Market Strategist at Exness, and this is your weekly market outlook for March 11th, 2025. Trump's tariff threats were not just rhetoric. He declared that there was no room for negotiation with Canada and Mexico, and the tariffs were officially imposed. In response, China, Canada, and Mexico all announced retaliatory tariffs, freezing market sentiment. The US levied a 25% tariff on Mexico and Canada, while an additional 10% tariff on Chinese import took effect, pushing US tariff rates to their highest level since the early 1940s. China retaliated by imposing up to a 15% additional tariff on American goods, including corn and soybeans. Meanwhile, Canadian Prime Minister Justin Trudeau immediately imposed a 25% tariff on Canadian dollar 30 billion worth of US imports and announced that an additional 125 billion Canadian dollar in tariffs would follow in 21 days. In response, President Trump warned that if they retaliated with counter tariffs, the US would immediately raise reciprocal tariffs by the same margin. Of course, given its large economy and relatively low trade dependence, the economic losses for the US are smaller compared to Mexico and Canada. However, the negative shock is undeniable. If the US imposes a 25% tariff on Canada and Mexico, and both countries retaliate with equivalent tariffs, the US annual GDP growth rate would decline by 0.32 percentage points. In contrast, Canada's and Mexico's GDP growth rates would shrink by more than 3% each, 10 times the impact on the US. Another key point is that these tariff threats could ultimately fuel inflation. Goldman Sachs estimate that 25% tariff on imports from Canada and Mexico could raise the US core CPI by zero point 0.6 percentage points. Meanwhile, in response to Trump threats, Eurozone leaders are pursuing decisive stimulus measures. Germany's incoming PM Merz has announced an ambitious infrastructure and defense investment plan. He proposed creating a 500 billion euros infrastructure fund over the next decade and exempting defense spending from Germany's constitutional debt limit. The European Union also signaled plans to relax fiscal deficit and national debt constraints, allocating at least 800 billion euro for defense spending. These strong accommodative signals from European leaders have sent shockwaves through financial markets. Anticipation of a surge in German bond issuance pushed the 10-year German bond yield up by more than 29 basis points in a single day, the largest one-day increase since the fall of the Berlin Wall in 1989. China's response is not much different from Europe's. The National People's Congress announced a strong growth target of around 5% for the year and raised the fiscal deficit target from 3% to 4% of GDP. Additionally, the issuance target for ultra long term bonds was increased by 30% from 1 trillion yuan to 1.3 trillion yuan. This highlights the Chinese government's firm commitment to supporting the economy through aggressive fiscal spending in response to Trump threats. The government has already signaled a shift in monetary policy from cautious to moderately accommodative through its annual two sessions meeting. As concerns over the US economy continue to permeate markets, investors have turned their focus to US labor data. The February NFP report showed an increase of 151K, exceeding the previous month 125K, and aligning closely with the market consensus of 160K. Despite disruptions from Elon Musk led Doge activity and extreme weather conditions, the data reaffirmed that the US labor market remains resilient. Notably, strong employment figures have positively impacted income growth, which in turn has bolstered consumer spending. However, not all aspects of the employment data were positive. The unemployment rate rose from 4% to 4.1%, adding to market concerns. More notably, the U6 unemployment rate, which includes individuals who want to work but have not actively surged in the past 4 weeks due to poor labor market condition, jumped by 0.5 percentage points to 8%. This suggests that the US labor market is weaker than initially expected. Wells Fargo noted that optimism about employment is fading, and growing tariff uncertainty is making it difficult for businesses to plan hiring strategies. The New York Fed Consumer Survey also highlighted rising concerns about the US economy. The survey indicated that household financial expectations deteriorated significantly in February, with 27.4% of households expecting their financial situation to worsen over the next year, marking the highest level since November 2023. Additionally, the average expected unemployment rate surged by 5.4 percentage points to 39.4%, reaching its highest level since September 2023. While inflation fears have somewhat subsided, concerns about economic slowdown have intensified, implying worries about stagflation. As a result, Wall Street pessimism about US economic growth is deepening. The Atlanta Fed slashed its Q1 GDP growth estimates to minus 2.4%, while Goldman Sachs revised its forecast down from 1.4% to 1.3%. Additionally, Goldman Sachs raised the probability of a US recession within the next 12 months to 20%, citing growing concerns that tariff policies are having a tangible impact on the economy. Morgan Stanley also lowered its US GDP estimate by 0.4 percentage points to 1.5%. The persistent tariff threats from the Trump administration and rising macroeconomic uncertainty have taken a toll on the market, hitting US mega cap stocks particularly hard. Apple plunged nearly 5% after delaying an update to Siri, which was seen as a negative catalyst. Major semiconductor stocks, including Nvidia, also tumbled more than 5%. Tesla suffered an even steeper decline, plummeting 15%, bringing its total drop from its December peak to 54%. The growing backlash against Elon Musk, who has emerged as Trump's closest ally, along with weakening EV sales globally, has further pressured Tesla. UBS cut its 2025 Tesla delivery forecast by 5% to 1.7 million units. Carefully review the above data before proceeding with successful trading. This is the end of the market outlook for the 11th of March 2025. I'm Inki Cho, the Senior Financial Market Strategist at Exness.